Welcome back to Generation Gains. Today we're diving deep into one of the most powerful strategies you can employ to build lasting wealth: long-term investing. If you're serious about achieving financial freedom, this strategy is the key to unlocking your financial potential. But before we dive into why long-term investing is so effective, let's break down exactly what it means. Long-term investing refers to the strategy of buying and holding investments for an extended period, typically 5 years or more. While many people focus on short-term gains, the key to building wealth over time lies in staying invested and allowing your assets to grow. Over long periods, stock markets tend to rise, even though there will always be short-term volatility. If we look at historical data, the S&P 500, which is a broad measure of the US stock market, has historically provided returns of about 8 to 10% annually. This holds true even when the market experiences temporary dips or corrections. The core reason why long-term investing works is that, despite short-term fluctuations, the market has historically trended upward over decades. Let's think about that for a moment. Imagine an investment that earns 8% annually over 20, 30, or even 40 years. The long-term returns compound over time, and the longer you stay invested, the more your money can grow. The key here is patience. By holding through the ups and downs, your wealth can grow significantly, even when the market takes short-term hits. One of the biggest misconceptions in investing is the idea that you can time the market, buying low and selling high. Many investors dream of catching the perfect moment to enter and exit the market, hoping to maximize their profits. However, research shows that timing the market is extremely difficult. In fact, the vast majority of individual investors are unable to predict market movements consistently. Instead of trying to time the market, the key is focusing on time in the market. By staying invested over the long term, you allow your money to grow regardless of short-term market fluctuations. Even if you experience dips in the market, the key is sticking to your plan and staying invested. The longer your money stays in the market, the more likely it is to benefit from the overall market growth. One of the most compelling reasons why long-term investing works is the power of compound growth. Compound interest is when you earn returns not only on your initial investment, but also on the returns you've already accumulated. Over time, this can create a snowball effect. Small returns at first, but accelerating growth as time passes. Let's break this down. Imagine you invest $1,000 and earn an 8% return annually. In the first year, you would earn $80. In the second year, your investment would grow by 8% on the new total, which would be $180. So your return is now $86.40, not just $80. Over time, the returns continue to grow on the original investment, as well as on the accumulated earnings. The longer you leave your money invested, the more you can benefit from compound growth. This is why early and consistent investing is so important. The earlier you start, the more time your money has to compound. Market volatility is inevitable. At some point, every investor will experience market fluctuations, whether it's due to economic downturns, global events, or other factors. The key to long-term investing is learning to ride out these bumps in the road. History has shown that the stock market always recovers from downturns. Let's take a look at the 2008 financial crisis as an example. The market lost significant value during that time, and many investors panicked, selling off their investments. However, those who stuck to their investments and remained patient saw their portfolios recover and even grow in the years that followed. The lesson here is clear. Short-term downturns are temporary, and long-term investors tend to recover and see positive returns as the market rebounds. Even during periods of uncertainty, maintaining a long-term mindset helps you avoid emotional reactions like panic selling. Those who stay calm and stick to their strategy are more likely to see long-term success. By focusing on the long term, you give your investments the chance to recover from short-term setbacks. One of the biggest threats to successful investing is emotional decision-making. Fear and greed often drive investors to make poor decisions. Buying when prices are high due to fear of missing out, or selling when the market drops because of fear of further losses. Both of these reactions can be detrimental to your long-term wealth. By adopting a long-term perspective, you help guard against these emotional impulses. Staying disciplined and focused on the bigger picture can help you avoid making rash decisions based on short-term market movements. The best investors are those who can detach from the day-to-day noise and stay focused on their long-term goals. When you invest with a long-term horizon, you're more likely to hold on through turbulent periods, letting your investments recover and grow without succumbing to panic. Avoiding the emotional roller coaster of market fluctuations is one of the key benefits of long-term investing. So how can you make sure you're investing successfully for the long term? Here are some strategies to keep in mind. Focus on assets with growth potential. Over the long term, equities, stocks, index funds, and ETFs have historically outperformed other asset classes like bonds or cash. These investments offer growth potential, which is crucial when building wealth over decades. Keep costs low. Fees and expenses can eat into your returns over time. This is why it's crucial to choose low-cost investments like index funds and ETFs. These types of funds typically have lower fees than actively managed funds, meaning more of your money stays invested and continues to grow. Make regular contributions. One of the best ways to ensure success with long-term investing is to make consistent contributions. Even if the market is down, continuing to invest regularly can help you take advantage of lower prices and benefit from the power of dollar-cost averaging. By sticking to a regular contribution plan, you make sure your investment strategy stays on track, regardless of market conditions. Be patient and disciplined. In a world where instant gratification is often the norm, long-term investing can feel counterintuitive. However, true wealth building takes time. Patience and discipline are essential. Stick to your plan, avoid making frequent changes based on short-term market movements, and trust the process. Review your portfolio periodically. While you don't need to check your portfolio every day, it's important to review it periodically. Rebalancing your portfolio ensures that your asset allocation stays in line with your goals, especially as you get closer to your target retirement age. 2025 is shaping up to be an excellent time to build or reinforce your long-term investment strategy. With economic recovery in many sectors, the stock market has the potential for significant growth in the coming years. Even if there are occasional dips, the long-term trend remains upward. If you're in your 20s or 30s, starting your long-term investment strategy now is one of the best decisions you can make. The earlier you start, the more you can benefit from compounding and the growth potential of the markets. Time is one of the most valuable assets you have when it comes to investing, so don't wait to begin. To recap, long-term investing offers several key benefits. Compounding growth. The longer your money is invested, the more it compounds, leading to exponential growth over time. Time in the market versus timing the market. Rather than trying to time market movements, focus on staying invested for the long term to capitalize on the market's overall upward trend. Market volatility is temporary. While short-term market fluctuations are inevitable, long-term investors have historically seen their portfolios recover and grow over time. Stick to low-cost, high-growth investments. Minimizing fees with low-cost investments like index funds and ETFs ensures more of your money stays working for you. Patience and discipline lead to success. Long-term investing requires patience, discipline, and a focus on the big picture. If you found this video helpful, don't forget to give it a thumbs up and subscribe to Generation Gains for more insights and strategies on building wealth. What's your long-term investment plan for 2025? Let us know in the comments below. Thanks for watching, and we'll see you in the next video.